Imagine a flashy 100% sign-up bonus dangling in front of your trading account, like, a shiny fishing lure.
Right. It looks amazing dancing on the surface.
Exactly. But are you about to catch a fish, or are you the one being hooked? That is today's mission for this deep dive. We are looking into Forex broker bonuses. So, okay, let's unpack this.
Well, to understand that lure, you really have to look at why the broker's casting it in the first place. I mean, brokers use these promotions for customer acquisition, market participation, and retention.
Yeah, they want you traded on their platform.
Exactly. So whether they call it a deposit bonus, a welcome credit, or a loyalty reward, you have to remember it is never just free money.
Well, let me push back on that a bit, specifically on the no deposit bonus I'm seeing in the sources.
Here?
Because if a broker strictly limits your ability to withdraw those funds, it basically just looks like a useless gimmick to me. Like, why bother trading if I can't actually cash out the money?
I get that. But it really only operates like a gimmick if you're trying to use it as long-term funding.
Oh, so it's not meant for building your actual account?
No, not at all. In reality, a no-deposit bonus is a trial mechanism. It lets beginners test live market conditions, see how orders are handled, and check the actual spreads in real time.
Without putting their own capital on the line.
Right. You're basically trading with house money just to test the house's infrastructure.
So you're just testing the plumbing. But if the no deposit bonus is just a harmless sandbox, where do the actual traps lie for traders who are putting up real capital?
That's where the fine print comes in.
Yeah, reading the fine print in these sources reminds me of getting a free gym membership that is immediately revoked unless you work out 5 times a day.
That is a great comparison.
The turnover requirements just seem mathematically designed to make you fail. Here is where it gets really interesting, though.
Yeah, the sources really highlight that specific trap. The most dangerous combination you'll see is an oversized lot requirement paired with a really short deadline.
Right, so they rush you.
Exactly. When a broker demands you trade a massive volume in a narrow window just to keep your bonus, it completely strips away your risk control. It forces a change in your behavior.
Aggressively nudging you right into overtrading. Because you end up taking subpar setups you would normally ignore just to beat the clock on the promotion.
Spot on. And on top of that, you have to watch out for hidden instrument restrictions.
Wait, what do you mean by instrument restrictions?
So some brokers exclude hedged positions entirely, meaning if you use offsetting trades to manage your risk, literally none of that volume counts toward unlocking your bonus.
Wow, so you're just spinning your wheels.
Yeah, or they might only count volume from certain asset classes, which forces you to trade completely outside your expertise.
Meaning if your specific strategy relies on those excluded methods, the bonus is completely useless to you anyway.
Exactly. Which leads to the ultimate rule from the sources. A useful bonus supports a decision you were already prepared to make.
And a distracting bonus tries to become the decision.
Yes, beautifully put. Which is why you have to focus on the foundation first, like fast deposits, clean execution, platform stability. Those are core necessities, not extras.
Right. You need the basics working.
Yeah, if you look at a broker like Monaxa, they integrate bonuses into a broader ecosystem of copy trading and multiple account paths, rather than just using a one-off campaign as bait. Because, well, a bonus cannot fix poor trading conditions.
So it sounds like a bonus is never a foundational reason to choose a broker.
Never.
If their baseline execution is terrible, a 50% deposit match is not going to save my trades. It's like a tailwind. Nice to have if you are already heading in the right direction, but totally useless if your ship has holes in the hull.
That is exactly how you should look at it.
But before we wrap up, I want to leave you with a final thought to chew on. The sources note that extra credit doesn't remove market risk, it only changes your available margin profile.
Right, and this is a critical mechanic that trips people up all the time. When a broker inflates your equity with bonus credit, they allow you to open much larger position sizes.
Which sounds great at first.
Until it isn't. Because if the market moves against you, that bonus credit usually cannot be used to absorb those losses.
Oh, wow.
Yeah, once your real cash is gone, the broker triggers a margin call and wipes out your positions. It is purely an illusion of safety.
So consider this. How might the psychological pressure of a ticking bonus deadline secretly alter that strict, ironclad risk control strategy you thought you had? Next time you see a massive promotion, ask yourself, are you still fishing for the right trades, or are you just thrashing around on the hook?